Good morning. My name is Tiaan Herselman. I am the head of advice at Old Mutual Wealth. And today it is my privilege to talk about retirement planning with you and all of the elements that make up a retirement plan. Now, the concept of retirement has changed over time. Previously, if we look back from the early centuries and in the dark ages, somebody went on retirement when he could no longer contribute to the tribe and they would let him be. But as a society, we've evolved and we've started putting measures into place to take care of our elderly people and take care of people that have contributed to society for most of their life. And today I'm going to unpack all of the different elements that make up a retirement plan by looking at a couple of scenarios and sharing all of those insights with you. So today I'm going to be talking about retirement planning and considering all of the different elements that make up a retirement plan. But first, we have to take stock of the last 12 months and what a 12 months it's been. Even if you go further back to 18 or 24 months, there's been a lot of events that shifted our expectation to what we expect in society and markets and even possibly retirement planning and our outlook on our investments. So if we look back briefly, we saw COVID-19 hit its third wave in South Africa. We've seen the numbers slightly dwindle in the last couple of months. President Joe Biden was elected. Donald Trump did not make his second term as the president. The rand surprisingly came back against the dollar. And we saw Prince Harry and Meghan Markle quit the royal family, even being interviewed by Oprah. We saw the Black Lives Matter protesters gaining a lot of traction, especially after the unfortunate death of George Floyd. We then saw businesses being looting as a result of our ex-president handing himself over for incarceration. And more recently, we saw the Israel-Gaza conflict build up again. It's been going for centuries now, it feels like. And then more recently, we saw the Taliban take control of Afghanistan the moment that the US forces left Afghanistan. And all of this left investors feeling fearful, uncertain, and anxious. And we can expect this during times which are unprecedented for us. It's the first pandemic we've ever gone through. And seeing all these conflicts go up overseas, locally, and abroad. Now, if we relay this back to retirement planning, the picture doesn't look great. We might be world champions at rugby, but we are not champions of retirement planning. A study done across people in South Africa earning more than 8,000 Rand a month and above showed that 46 to 49% of individuals have no retirement plan whatsoever. 45% of individuals believe that they only need 25 years to save for retirement. And a shocking 60% of people, when moving employers, cash in their retirement savings when they move employers. And we've also seen certain proposals or some potential proposals made by Treasury to also potentially alleviate the limits upon withdrawing from retirement funds before retirement. Interesting space to see how that will play out in the next couple of years as well. But what actually happened in investment markets during all of this period of feeling uncertain, feeling anxious? What actually played out in investment markets and how did that correlate with human behavior and what did we see investors do? Well, if you went into gold, the age-old investment for consistency, you would have lost 23% over the last 12 months. And when I say lost, not lose, but you would have seen a decrease in value of 23%. If you'd gone into Bitcoin, you would have made 2.4 times the capital invested. Although keep in mind, from roughly April, May, you would have seen a 50% decline and recently another resurgence in Bitcoin. Also, keep in mind, there was 3 years from about 2018 to early 2021 where there was no growth in Bitcoin. And the All-Share Index up 20% the last year. However, if you look at the All-Share Index's return from the bottom of the market when the pandemic hit, so if you had the courage to invest, to buy when it was cheap, you would have had an 83% return. In simple terms, if you invested 1 million Rand, you would have had 1.8 million Rand 12 months, or at the bottom of the pandemic up until now, your million Rand would have grown to 1.8 million Rand. The S&P 500 in dollar terms returned 39%. That's in hard currency in US dollars. The MSCI World Index returned 31% in US dollars. And then the South African Rand, compared to the dollar, actually strengthened by 15%. And we saw a little bit of weakening in the last couple of months. Now, needless to say, it's actually been a good time for markets. If we look at balanced fund returns over the last 1 year, we saw a 10 to 22% return. Keep in mind the all-share index return as well. And having seen this 83% return in the all-share index, it's been a great time for investors. However, we saw the opposite happening. And we would have thought that looking at history, we would have known that when there's a pandemic or a market crash or market volatility, upward and downwards movements in investments, generally we tend to see a big upswing in 12 to 36 months. If you look back, and this is the all-share index displayed on one graph showing all of the crises that we faced in the last 50 years or so. We saw the Black Monday crisis, the Asian crisis, the tech bubble burst, the financial crisis, and more recently, the coronavirus crisis. And if we look at it a little bit closer, you'll see that every time there was a big market crash or volatility, if you look at it that way, if you look at the 75 to 77 dip, it took us 61 months to recover from that. During the time when the Soweto riots took place, roughly in the time between P.V. Botha's Rubicon speech, we took 25 months to recover from a decline in gold prices. We took 23 months to recover in the 80s, early 90s. We saw 18-month recovery at just before the turn of the 2000s. We saw a 27-month recovery in early 2000 during the tech stock bubble burst. And then during the US American housing crisis, we saw a 30-month recovery period. However, at the end of that, investors who remained invested, who invested just before the crisis, would have had 120% return. So if one thing we can take out of history, or we've been taught by history, is that when there is volatility in our markets, we tend to recover between 12 to 36, and in some cases 60 months, but markets tend to always come back. However, what we saw investors let their emotions ruin their investment decision-making, especially over the last 18 months. So an article by Fin24 showed how clients of Momentum Wealth actually lost 100 million rand because they switched from more aggressive equity-bearing investments to more conservative cash-based investments. They switched 15 billion rand during a period where the market returned 54%. And the reason for this investment decision-making, which is purely driven by emotions, is due to the fact that most people don't have a plan. It's like boarding an airplane and your pilot is only navigating based on what he sees before him. If he has a clear sky with an open view, his decision-making will be completely different to when it's cloudy, when the weather isn't looking too good. And that's why a pilot in the cockpit of an airplane or an aircraft has various plans that he's implementing based on the data he's receiving. He doesn't just let it go over to his emotions and what he can see in front of him, but he makes decisions based on good information. And the same is true of our retirement plan. If we base our decision-making for our investments off a solid retirement plan, we tend to make less emotional decisions and less irrational decisions with regards to our investments. So what are the elements of a retirement plan that I can control? Because clearly, and one can always debate this, but it's very difficult to control markets. None of us could have foreseen the COVID-19 pandemic taking place. However, it did have an impact on markets. And for those of us that learned from history, there was some money to be made. Now, I want to talk about retirement in a different light. The concept of retirement has actually changed significantly over the years. And retirement almost has three levels to it. The first one is financial security. That's the point where your passive income or your assets can cover your basic living expenses. And that's the point to which most people actually strive for in their retirement plan. The second step in your overall retirement planning is financial independence. That's the point where your passive income actually covers your existing lifestyle. So between you being in an environment where you are working, where you are earning an income, whether it be from your business or from your salary as an employee, that passive income that you earn from your assets can actually give you the same lifestyle that you are sustaining today. And then we get to financial freedom, which is where your passive income covers your ideal lifestyle. And this is such a great place to be, where you can decide where you want to live. What does retirement look like? Do you see yourself being at the coast, being inland with the kids? Do you see yourself traveling? Do you see yourself still working, maybe starting a non-profit organization, where you actually have the financial freedom, where your passive income and your assets provides you with the ideal lifestyle? And today I'm going to give you a bit of an insight as to how we at Old Mutual Wealth approach this process of bridging the gap between financial security and financial freedom for clients, and how we create more certainty amidst a period of extreme uncertainty. Now, any financial plan, whether you've got 100 Rand or 100 million, is made up of 4 numbers. The first number is the available assets that you have. This might be properties, business assets, retirement funds, investments, etc. The second number is, what does this ideal lifestyle look like for you? The third number is, what kind of return can you expect on your assets, on your capital? Which then gives us the fourth number, well, how long can this asset base sustain this ideal lifestyle? What is the lifespan that this asset base can support? Now, we can work out any one of these 4 numbers to get you towards financial freedom if we know what the other 3 are. So as an example, if I knew somebody had 10 million Rand to invest, I knew they wanted to sustain their ideal lifestyle of 30,000 Rand a month going up with inflation, and I knew we could expect a return of 10% per year. I can then work out, well, how long this asset base can sustain this ideal lifespan. And you can think of each one of these 4 numbers as a button in your financial plan or your retirement plan. And the buttons in my plan is completely different to the buttons in your plan, because we are all unique, we are all different, and we all have our own unique set of buttons. But it's important to understand the impact that each button has on your financial plan. So I'm going to be showing you a couple of graphs and a couple of scenarios. And what are we looking for here today? The only thing you need to focus on is this red section on the graph that I'll be showing you. And the question is, what does this red section mean? Well, in simple terms, it means that I cannot sustain my ideal lifestyle. That financial freedom that I'm longing for, I can't sustain it because there is a expense or goal that my asset base or my passive income can no longer sustain in my financial plan. And this is due to 2 reasons. The first one, if it's a capital goal, it means I have no liquid capital to fund this. In other words, if I have a vehicle purchase, I want to go travel offshore, I want to spend money on maybe repainting my house, I don't have liquid investments that I can easily access to pay for that. That's the first reason you'll see red. The second reason is there is an expense, a monthly expense, and I've run out of liquid capital, and my retirement funds, which in retirement, based on my example, is capped at 17.5%. I can't draw more than that due to legislative limits. So if you see red, it means that you can just simply no longer sustain your ideal lifestyle, that financial freedom that we are talking about today. But before we get there, we quickly have to distinguish between 2 types of investments in general. In the South African landscape, you have 2 kinds of investments. You have retirement assets and you have non-retirement investments. Retirement or non-liquid investments, and non-liquid simply means that I can't just go withdraw the money whenever I want to. These are your retirement annuities, your pension and provident funds, your preservation funds. And then if I get to my non-retirement or my liquid investments, these are usually unit trust, ETFs, share portfolios, endowments, or sometimes we refer to these as life-wrapped investments, cash, savings, fixed bonds, or tax-free investments. And there's 2 big differences between these 2 types of investments. The one is the flexibility and access to capital, the non-retirement or liquid investments being much more accessible than your retirement or non-liquid investments. And the second one is how these investments are taxed. Now, if we look at these differences quickly, the accessibility to capital and taxation, it looks as follows. Your retirement funds, in your build up to retirement, there's no tax on interest, dividends, or capital gains. So every bit of growth that you get goes back into the investment and there's no tax taken off that. However, when you get to retirement, every 1 Rand that you draw as an income from your retirement funds is taxed as per PAYE. In other words, the same way in which your salary is currently taxed. So the government says, while you are contributing to this investment and while it's growing to fund your retirement, there's no tax applicable. But the moment you start drawing in retirement, we tax every 1 Rand as if it is a normal income or salary that you are earning. At retirement, you can choose to withdraw an amount subject to tax, which is usually limited to 1/3. And there will be tax applied on that 1/3, where you can say, look, I have 3 million rand to invest. I'm allowed to take out 1 million, and that'll be taxed according to a sliding scale. And then the after-tax amount will be paid over to you. The remaining 2/3 or the full amount has to be invested in what we call either a living annuity or a guaranteed income investment. And the living annuity, you can draw between 2.5% and 17.5%. That's set up once a year. Or you can take out a guaranteed income where you forfeit your capital, you give it to an insurance provider, and they give you a guaranteed income. The living annuity, it's based on market movements, but you have more flexibility on the income that you draw. And these investments provide very little flexibility to access the capital, but there are great tax deductions offered by SARS for contributions before retirement. So you can think of them as being very tax efficient before retirement, but almost very tax inefficient at retirement. Then we get our liquid or discretionary investments. Now, here we pay tax on interest, dividends, and capital gains, except for the tax-free accounts or tax-free investments, where there is no tax on interest, dividends, and capital gains. It's much more tax efficient in retirement, but you get no tax deductions or exemptions leading up to retirement, except for your interest exemption and exemptions on capital gains. So, leading up towards retirement, you get tax on your interest, your dividends, your capital gains, except in certain structures such as a unit trust, you get your personal interest exemption of 23,000 Rand, and in retirement that's a bit higher. And then you get also a capital gains tax exemption for any capital gains that you make, and dividends is taxed at a flat rate of 20%. But it does give you much more flexibility, as you can easily access the capital when you need to, except for endowments and fixed bonds where there are certain limitations. So the two main differences between these two types of investments is the one gives you a lot of flexibility, the other one gives you less flexibility, but it's more tax efficient before retirement, and what you give up there is being less tax efficient in retirement for the retirement funds. Now, let's look at a client scenario to start unpacking these different elements of a financial plan or a retirement plan. So here we have Mr. Daniel Jack, who's 55 years old. He plans to retire at the age of 63. He has his own consulting firm, and he's divorced and he has no kids. And he's approached us at Old Mutual Wealth to help him put together a retirement plan and to help him with his decision making as to what the triggers are in his financial plan, because he's part of the 45% that is never planned for retirement. His investments, he's done relatively well for himself. He has a retirement annuity of 3 million Rand, to which he's contributing 15,000 Rand per month. He has a preservation provident fund of 1.3 million. He also has a cryptocurrency investment with Bitcoin worth 1 million Rand. He has cash and savings of 400,000, and he has an offshore investment worth 3 million. So he's done very well for himself, and he's always been a diligent saver. His ideal lifestyle, his financial freedom in his world, would be to fund living expenses of 40,000 Rand per month after tax, increasing every year with inflation. Further, he'd like to purchase vehicles for 400,000 Rand in today's money every 6 years from the point where he retires up until his 80s, which is 4 vehicle purchases. And he wants to go on annual holidays for 30,000 Rand every year in retirement up until age 85. Now, he also has some properties, and he also has a business. So his business is conservatively valued at 4 million Rand, and we've assumed that it goes up at inflation every year of 5%. His primary home is valued at 3 million Rand. He has a bond of 800,000 Rand, and he's currently repaying 14,000 Rand per month at an 8% interest rate. He also bought the home for 2 million Rand back in the day. He further has a holiday home of 2.2 million, which he owes no money on, and he bought this for 1.9 million Rand. And then he also has a Range Rover of 800,000 Rand. And his first question is, well, what does my initial retirement plan look like? And where am I on this journey towards financial freedom? I've seen all of these things happen. I've heard about markets being up, being down. COVID's happened. I've seen a new president offshore. I've seen the things happening in Afghanistan. And I just don't know, where am I in my retirement plan? And what does it actually look like? And should I be concerned by all of the noise that I'm hearing? So we used our wealth integrated financial planning model that we built along with our financial planners. And our first starting point was saying that the 40,000 Rand that he wants per month, 2.5% from that will be funded by his retirement investments in retirement, where we've gone into the living annuity structure after we've taken 500,000 Rand out as a lump sum. Once the 2.5% is not enough, we'll take the balance from our liquid investments which includes the 500,000 we took as a lump sum to fund the 40,000 Rand. So we first take 2.5% from our retirement funds, then we go to our liquid investments, and he's asked us that he specifically wants us to not touch his offshore investment in funding this particular lifestyle. And once we've run out of his liquid capital, then we'll go back to his retirement funds and we'll automatically increase this up until the allowed limit of 17.5%. And this liquid capital not just has to fund the 40,000 Rand, it also has to fund his vehicle purchases and his annual holidays and his financial plan. Now, we've assumed that all of these investments get a conservative return of inflation plus 2 to 3%. So if inflation is 5, 2 to 3 is 7.5%. That's the after asset management fees, but before some planner and admin fees. And without making any changes, this gets him to age 69, which comes to a bit of a shock, quite a big shock to Daniel Jack. And you can see that these little purple dots are all the capital goals, the vehicle purchases, and the travel that he needs to fund. But after age 69, he can no longer fund that. So let's go into that liquid versus non-liquid split of his funds and see what's actually happening there. And the light blue capital on the graph is his non-liquid capital. That's the capital that he can easily access. The dark blue capital is his retirement funds. And we can see that we start dipping into his liquid capital in retirement very quickly early on. And the reason for that is due to the fact that we are only drawing 2.5% from his retirement funds. So if I go to my income and expenses graph, the income I'm getting in retirement, which is the light blue line, from my retirement funds is not enough to cover the expenses, the dark blue line, in retirement. And that gap between these two lines is actually funded by my liquid capital. And that's why you see the liquid capital taking such a steep dip. When the liquid capital runs out at age 68, 69, then we increase the drawdown from the retirement funds until we reach the 17.5% limit, because that's the current legislative limit that we can draw. And at age 72, we reach that limit. So after age 72, we can no longer fund his monthly expenses. And after age 68 and 69, we can no longer fund those vehicle purchases and those holidays. And if we look at his debt, if we go to his liabilities graph, we can see that a part of his expenses in retirement, he's still paying for his bond repayments because his bond is actually not settled in retirement. There's still an amount of about 500,000 Rand outstanding. So our starting picture is we can meet your income needs, your financial independence, that we can meet up until age 72. That's your living expenses every month plus your bond repayments. But from age 69, you will no longer have financial freedom because those vehicle purchases, those pink or those purple dots, and your travel goals will no longer be able to be funded. So our starting point for his financial plan, there's only 4 numbers in any financial plan. We know what the assets are. We've got local investments in cash, lifestyle assets, which is his properties and vehicles of 6 million. We have his business. We have a surplus asset offshore. We have the cryptocurrencies. We have some liabilities, which gives him a big total of roughly about 18 million Rand. We know what we need to fund, what the ideal lifestyle is. It's the 40,000 Rand for the living expenses, the 30,000 Rand for the annual holidays, and the 400,000 for the vehicles every 6 years. And the last two, the vehicles and the holidays, is shown by these little purple dots here on the graph. Now, we've made a conservative assumption with the return, assuming inflation plus 2 to 3%, which in simple terms is 7.5% per year. And without making any changes, that gets us to age 69. Now, as you can imagine, this came as quite a shock to Daniel. And in actually reviewing this plan with him, his question was, well, which one of the 4 buttons should I consider? And which will make a big difference to my financial plan? So we went to the button he requested, which most people look at and most people worry about, which is the return button. So we said, well, what would happen if we targeted a higher return on your capital? So no longer a conservative portfolio with limited access to equities, giving you a less volatile ride, in other words, less up and downwards movements. What if we introduced more equities to your portfolio to target a higher return over the long run? So we went back into his plan and we took his current starting point, which we'll call his current scenario, and we created a new scenario. And we called this our plan scenario. We took over all the information and we copied it over and we created this new scenario, which we called scenario 1. And the only thing we changed in the scenario was we targeted a higher return on the capital. So you can see we still cannot sustain the lifestyle past age 69. But now we said, let's introduce our exposure to equity before retirement, and let's target inflation plus 5 to 7. So 11% per year before retirement, and let's target a less conservative, a moderate return of inflation plus 4 to 5, so 9.5% post-retirement. And that got him to age 71. But now important, what he needs to understand is this kind of portfolio, targeting inflation plus 5 to 7, in any 1 year can give a return of minus 15 and 37%. So over any 1 year period, that's the return that he can expect from such a portfolio. The longer you remain invested in such a portfolio, which we consider a moderately aggressive portfolio or a balance-like portfolio, the likely range of returns start narrowing. And over the recommended term for Daniel Jack, the risk of, or the range of returns reduces from only between 2% and 20%. So over the 10-year term, there's very little to no chance of a negative return. Now, if we talk about probability of a negative return, which is the second thing we need to take into account for such a portfolio, over any 1 year period, so all the 12-month periods going forward that we consider, this portfolio has a 20% chance of giving a negative return. So over any 1 year period, if I take the next 5 1 year periods, one of them will be negative in this portfolio. And that is based on economic theory and looking at how equities normally behave. If I look at a 2 year period, the 20% chance of a negative return goes down to 10%. So in other words, if we look at the next 10 2-year periods, one of them will be negative. However, the longer you remain invested in this portfolio, the chance of a negative return reduces. And over 7 to 10 years, your chance of a negative return is 0.8%. But having made all of these changes now, he can sustain his lifestyle all the way till 71, but we still see him running out of liquid capital at age 71. So that means that he can no longer go on holidays, he can no longer buy vehicles, but at least now he can sustain his income needs, his financial independence, up until age 81, 82. So if you are only worried about markets and his only concern is the return that he gets, that's actually not the biggest trigger in his financial plan. So targeting a higher return, pushing that particular button for him, takes him from 69 to 71, and it takes his income payments, that 40,000 Rand plus the bond repayments, it at least sustains that up until age 82. Then he said, well, I'm an entrepreneur, I'm doing quite well. What if I could potentially save more? Now, you've spoken about liquidity a lot, Tiaan. What if I saved into a liquid investment? So we then took the plan and we said, well, what if we could save his surplus on a monthly basis? So currently, he has a surplus every month of 10,000 Rand that he could afford to put away. And by putting that 10,000 Rand into a unit trust investment, targeting the same return, we could now at least sustain our income, the 40,000 Rand plus the bond repayments, up until we still need to pay them, up until age 86, 87. If we now look at our liquidity, our access to liquid capital, that is now only depleted at age 74, 75. Then we only run out of liquid capital. So by saving more, saving 10,000 Rand per month, that gets his plan from age 71 till age 75. It makes a 4-year difference. However, the income now can be sustained up until age 87. So you can see now the purple dots, his financial freedom goals, vehicle purchases, travel. We can't sustain that past age 75. However, at least we can sustain his income all the way up until age 87. So saving more gives him an additional 4 years into his financial plan. Then he said, well, what if I could reconsider my budget and reduce my expenditure in retirement? So what if I went from financial freedom, which I'm looking at, to maybe just financial independence, where I can at least cover some of my costs, or maybe down a step to financial security that I know my basic expenses are covered. So remember, we have financial freedom at the top, we have financial independence, and then we have financial security. So now we're kind of going down the line from financial freedom to somewhere between financial security and financial independence. We then took the model and we said, okay, well, what if we dropped your expenditure in retirement from 40,000, and what if we dropped that by 5,000 Rand per month? So we said your after-tax income that you need to get in retirement is no longer 40,000, but now it's 35,000 Rand per month. And now you can see we can now sustain his monthly income needs all the way up until age 93, 94, 95. If we now look at his liquidity, is liquid capital. And again, I keep on referring to liquidity, this capital that you have access to, because it's so important to have access to capital in retirement when you most need it for unplanned expenses. Now he has access to liquid capital. You can see those big little jump downs is when he buys his vehicles, but now he has access to liquid capital up until age 77. So in this case, or age 77, 78, we can fund your income needs up until age 95, but your holidays, your vehicle purchases, that we can only fund up until age 78, because that's the point at which you have no more liquid capital. So this one change made a 3-year difference. Then he said to me, well, Tiaan, you keep on talking about liquidity. How do we improve this liquidity problem? And liquidity is probably the thing that we see at Old Mutual Wealth that most people don't spend enough time considering in retirement. It's something that people don't spend enough time looking at, and especially when you consider where you're investing your capital, it's so important getting the balance right between liquid capital, i.e. non-retirement funds, and non-liquid capital, i.e. retirement funds. So what if we could make some changes that would cost him nothing, and what impact would that have on his overall financial plan, and would it get him closer to financial freedom? Well, we took the same scenario and we said, well, let's do two things now in this particular scenario. At retirement, you have the option to take some money out of your retirement capital. It's usually limited to 1/3. So we said, let's take an amount, or let's withdraw an amount of 1.5 million at retirement out of your retirement capital. And let's put that into your liquid capital. So take it from the dark blue pot and put it into the light blue pot. By doing this, it would mean that we'd have to pay a speeding fine, a tax bill of close to 300,000 Rand to SARS, but we get out 1.2 million, which is liquid, which is more tax efficient, and which you can access at any time to pay for your vehicles and your holidays and help fund your monthly expenses. The second thing we said was, let's no longer only draw 2.5% from your retirement capital, the big dark blue pot there. Let's take that up to 5%. So let's put less pressure on your liquid capital by drawing more from your retirement capital. And immediately now we see a significant improvement to liquidity. All of a sudden, I now have access to liquid capital all the way up until my age 99, 100. And I can fund my monthly expenses all the way up until age 99, 100. I can fund all of my vehicle purchases, and I can fund all of my holidays. And this gets me one step closer to financial freedom again. So that one change, commuting more and paying a bit to SARS and drawing more from my retirement funds at retirement, made a 21-year difference to the overall plan. Now, that's something that people don't take into account. And the reason being is that if you have to escalate your drawdown on your retirement funds immediately later on in retirement, it takes your tax bill up significantly in one shot. I've seen cases where clients have had their tax bill increased by 30 to 40% because they run out of liquid capital, and now they need to increase their expenses because that includes their tax, because they have to draw more from their retirement funds. Where your liquid capital is much more tax efficient because the only tax you're paying on is tax on interest, dividends, and capital gains, which is much more tax efficient than paying pay as you earn tax on every R1 you draw from your retirement funds. But what about medical aid increases in retirement? Again, something a lot of people don't consider in their financial planning. Well, in this particular case, we said, what would happen if I modeled and I added medical aid to the plan? So that's 35,000 Rand per month that I had. Currently, I dropped it down to, what I'm going to do is I'm going to increase that back to 40,000 Rand per month. So remember, I took it from 40 to 35,000, but I'm going to add in here 5,000 Rand now for medical aid. But the difference being is I'm going to escalate the medical aid, not at inflation of 5%, I'm going to escalate that at inflation plus 4%. So in other words, 9% increases per year. And that takes my plan back all the way to age 80. And one thing we also see people not planning for in retirement is the impact of medical aid escalations, which tend to go up much higher and much faster than normal living expense escalations. So that one change, increasing my living expenses by adding medical aid, took my plan back by 19 years in totality. And then Daniel said to us, well, I don't see myself retiring at age 63. I'm quite fit, I'm young, I feel good, my health is in an overall good condition, and I'm quite enjoy doing business. I like my business, and I don't see myself retiring at 63. What if we moved out my retirement age, but I kept on contributing to my retirement funds, and I didn't have to access my investment assets early on. So we moved his retirement age from 63 to 64. That got us from 80 to 84. So it's kind of a 4 and 1 year ratio. We then moved it out from 64 to 65. And then that got us from age 84 all the way up until age 90. So moving out my retirement by 2 years made a 10-year difference. So think about that. That's the benefit of compound interest starting to work in your favor, especially later on in retirement, where you can see the significant increase in capital value as compound growth starts working for you. So working an additional 2 years made a 10-year difference to his financial plan and got him closer to financial freedom. And then he said, well, what impact does my current bond debt have on my retirement plan? Because remember, he's not yet debt-free at retirement. Well, we then looked at his plan, and we specifically honed in on his liabilities, the amount that he owes on his bond. And currently we can see once he gets to retirement at age 65, he owes roughly an amount of about 550,000 Rand per month. Well, that means that he goes into retirement still having a bond repayment of 14,000 Rand. So his expenses aren't just 40,000, it's 40,000 plus the 14,000 Rand for the bond repayment. And the question then was, well, how much would I have to increase my bond repayment to make sure that it's paid off at retirement? Well, we asked the model to calculate for us, and he'd have to spend an extra 3,300 Rand in bond repayments, or let's say 3,400 Rand, to make sure now his bond is settled at retirement. What that meant for him is it meant that his financial plan, the age to which he could sustain his financial freedom, his monthly expenses, all of his goals, his objectives, increased to age 93. So becoming bond free at retirement, so putting an extra 3,300 Rand or 3,400 Rand into his bond, increased the longevity from age 90 to 93. Or in simple terms, it added 36 additional paychecks in retirement and allowed him to further fund his holidays and fund his vehicle purchases, which are the purple dots you can see on the graph. The next question was, well, have you factored my business disposal into my retirement plan? Because I'm putting a lot of money into putting a business strategy in place. I've started looking at potential successes for my business, and I want to see what impact that could have on my overall financial plan. So we assume this is a small business, so we would benefit from the small business exclusion that we get from SARS, and we would then dispose of the business at retirement. And we made a very conservative assumption. We assumed that he would only get 50% of the valuation for the business at that time. We thought it would be a more conservative assumption to make in the model. And disposing for his business and investing the money into an investment asset, that got him all the way till age 105. So this particular business asset in his plan is actually a big part of his overall financial plan. So in pushing the assets button in his plan, which one of them is the business, it actually had a 12 years worth of longevity. So a key part of his financial freedom strategy or retirement planning strategy is making sure he can find a successor and also a willing buyer to take over the business and to start structuring his business in such a way that he can sell it at the price that he deems fair or according to the valuation. But in our case, we've assumed he only gets 50% for the business. The next question is, well, what if we considered a life annuity with a portion of my capital? In other words, a guaranteed annuity. Now, as I mentioned earlier, with regards to your retirement funds, you can take out 1/3 at retirement, generally speaking, and the remaining 2/3 has to be invested into either a living annuity or a life annuity, or some people call it a guaranteed annuity. Now, the living annuity, you are at the mercy of the markets, and you can choose to draw 2.5 to 17.5% once a year, and you are then, based on how the investment performs, you will have an income for a certain amount of time. If markets do well and your drawdown is low, you will have an income for longer periods of time, and you can control how much income you'd like to draw. The life annuity, however, is where you say to an insurance provider, I'm willing to forfeit my capital if you take on the longevity risk of paying me this income for the rest of my life, either at an escalation rate of inflation or at a 0% escalation rate. So we've assumed that his retirement annuity, which is his biggest retirement asset, we would convert that at retirement to a life annuity, a guaranteed annuity. So we went back to his retirement planning scenario and we said, well, let's go back to this particular asset. And let's assume that because I'm 10 years away from retirement, we're not going to take any risk with this capital. We're going to invest very conservatively to make sure that I get a certain capital amount at retirement, which brings back my plan by quite a bit. But once I get to retirement, I'm going to take this retirement annuity investment, which at the point of retirement, if we go into this particular asset, is worth 5.3 million odd at retirement. I'm going to forfeit this 5.3 million rand worth of my own capital, and I'm going to give that to an insurance provider, which will give me a guaranteed income. So I'm going to remove the capital from the plan as if it never existed, but now I'm going to add an income, but I'm still going to make sure I withdraw 1.5 million before I do that as a lump sum from my preservation provident fund, because I still want that liquidity. I need the liquidity in my financial plan. So I'm still drawing the 1.5 as a lump sum from my other retirement asset. But now I'm assuming that I'll get 4,500 Rand per million Rand invested as a guaranteed income, increasing with inflation for the rest of my life. And that equates to 23,850 Rand per month in today's money, increasing with inflation. So I'm forfeiting 5.3 million to get 23,800 Rand going up with inflation every year. And that takes my plan from age 105 to 102. So I go backwards by 3 years, but I get much more peace of mind with regards to my income sustainability. Now, keep in mind, I assume that we de-risk the portfolio towards retirement, targeted lower return to make sure we get as close to that projected value as possible, which is purely a projection. And that's why the plan went from age 105 to 102. If I assume we take more risk and we got a higher return, I could have probably seen more longevity in this particular scenario. But this gives him a good blend between guaranteed capital and then also capital that's exposed to markets, where he has a bit more flexibility. Excuse me. Then the next question was, well, what impact does my cryptocurrency assets have on my retirement plan? I mean, I've heard a lot in the markets. There's a lot of opinions on crypto investments, but let's model some scenarios with regards to my crypto investment. And the first one we modeled was a worst case scenario for the crypto investment. Let's assume that crypto goes bust tomorrow. Now, most people will say that's unlikely. Other people might say that is very likely, but let's assume we remove your cryptocurrency investment, which is part of your retirement plan, from your assets and your retirement plan. Now, we were going to age 105. It takes 12 years out of your retirement plan. Or in simple terms, it takes 12 years worth of paychecks. So 144 paychecks is removed from your financial plan. So if we assume that something it's a very volatile asset, it might go down to zero or whatever might happen, then it takes off 12 years of your retirement plan. However, we also need to model the upside. So what if, in Daniel's opinion, what if my crypto investment actually does significantly well? And some people are of that opinion. So what if I don't get inflation plus 5 to 7? What if I assume that I get a growth rate every year of 20% per annum on my crypto investments? And if we then model 20%, again, our baseline figure is age 105. When we removed it, we went to age 92. But by now adding significant upside on the returns, it takes the plan to beyond age 120. So now he can make an informed decision as to what the downside risk is versus the upside potential of the crypto investment for his financial plan. And then he said to us, well, what if I wanted to spend more whilst I'm younger in retirement and I'm more active? Because in retirement, we generally see people going through different retirement phases with their expenditure. And to get him closer to this ideal financial freedom. So in retirement, we generally have 3 phases. We have the go-go phase, which is when you're busy, you're active, you're doing a lot. Then we have the slow-go phase, which was normally you start getting a little bit older, you don't travel as much, you don't do as much. And then you get the no-go phase where either it's one of the spouses unfortunately passes away or there's a medical setback. So he said, what if we really had a nice go-go phase in retirement where I increase my expenditure? So what we did was we said, okay, well, let's take your 40,000 Rand a month, which includes your medical aid, and let's increase that to 50,000 Rand initially in retirement. So what we did was we took the expenses from 40,000, which was 35 and 5 for medical. We took that to 45. So we increased your living expenses to 40. And we further added 10,000 Rand per month as a go-go expense all the way up until age 85. So it was 50,000 Rand plus medical aid up until age 85. And then it falls away, that 10,000 Rand. So in simple terms, we go from 35 and 5 for medical to 50,005, and the 50,000 becomes 40,000 at age 85. And that took the plan all the way back till age 87. So in doing that, we lost 18 years worth of longevity. was quite a big impact on the overall financial plan. And we got a little bit further away from financial freedom in doing that. So then we said, okay, well, what if I disposed of my holiday home, or I brought my offshore investment into the picture? Because the holiday home, I'm probably not going to use as much in retirement, or I'll probably stay in the holiday home or sell my primary residence. But in this case, we assumed that we disposed of the holiday home at retirement and freed up some more capital. That got the plan all the way to age 100. The second option we looked at is if you did not want to dispose of the holiday home, remember, again, we're pushing the assets button now. If we didn't want to do that, then if we brought the offshore investment into account, and we brought that into the plan, which initially Daniel said he didn't want to do, that gets us now to age 106. So the trade-offs here is if you want that financial freedom in your life, then you either need to bring your offshore investment back into the plan, or you need to dispose of your holiday home. And that adds 12 years by disposing your holiday home. And if we bring the offshore investment into account, it adds 18 years. Now, as I said earlier, there's only 4 numbers that make up any financial plan. There's your assets, your lifestyle, the return, and the lifespan. We can work out any one of these 4 as long as we know what the other 3 are. And we've now sat with Daniel. We've gone through all the numbers and the buttons in his plan. And now we can actually summarize all of this for him onto one page. So our starting point, we knew what our assets were. We knew what the lifestyle was. We knew what the assumption was on the returns we targeted. And that got us to age 69. The first trade-off we looked at was targeting a higher return. That got us to age 71, 81 for income. The second trade-off was saving 10,000 Rand into unit trust. That added 4 years, got us to age 75. Then we dropped the living expenses from 40,000 to 35,000 Rand per month. That got us to age 78, got our income at least to age 95. That added 3 years of overall longevity. Then we commuted 1.5 million and we increased the living annuity drawdown to 5% to take off the pressure off the liquid capital in retirement. That added a significant 21 years to the overall longevity for both income and being able to sustain his capital goals. We then added 5,000 Rand per month for medical aid, which brought us all the way back to age 80. It took off 19 years off the retirement plan. We then considered the impact of retiring 2 years later at age 65 because, as Daniel mentioned, he's young, he's fit, he's active, and he doesn't see himself retiring before the age of 65. That got him back up by 10 years all the way to age 90. We then added an additional 3,300 Rand per month into his bond to make sure that he's debt-free at retirement. That got him from age 90 to age 93. It added 3 years or 36 paychecks in retirement. We then disposed of his business for only 50% of the valuation at his age 65. That got him to age 105. It added 12 years or 144 paychecks in retirement. We then took the RA proceeds and we de-risked the portfolio. We put into a much more conservative portfolio. We made sure we get as close to the projected value as we modeled, and that got us to age 102, but it gave him much more certainty in the potential outcome in his financial plan. So it took him back 3 years, but it gave him much more certainty from an income sustainability perspective. And then we considered the impact, the downside of removing the cryptocurrency investment. That got us to age 93. It took 12 years off. But on the upside, it also added 15 years if we modeled good returns for the crypto investment. So as long as he's comfortable with those two kind of outer limits, then he can make an informed decision. And then lastly, the second trade-off we considered, second to last, was increasing the lifestyle expenses in retirement to a go-go phase. We upped it from 35,000 plus medical to 50,000, of which 10,000 Rand of that 50 falls away later in his age 80s or in his mid 80s. And that got him back to age 88. It took off 17 years worth of longevity and got him a couple of steps away from financial freedom. And then the last piece of the puzzle for him to achieve, to go from financial security to financial independence and then to financial freedom, was for him to either bring his offshore investment into account or to dispose of his holiday home. And that would get him to age 100 plus. Age 100 if he disposed the holiday home, age 106 if he brought the offshore investment into the picture. And that is his retirement plan summarized. Now, what this creates is it creates an environment for him to make informed decisions and not to be disturbed by all of the noise, all of the uncertainty, or for him to feel anxious, because now he knows all of the steps that he can take with us and what the actions are that he has to take to make this plan a reality. Now we can identify all the elements of our financial plan and the actions, like I mentioned, we need to take to bridge the gap between our current reality and achieving financial freedom. So not just financial security, not just financial independence, but actually getting to financial freedom. So in closing, there are many elements in a retirement or financial plan, and we need to understand what the triggers are in our retirement plans. The triggers in my plan will be different to the triggers in yours. Liquidity and tax efficiency is so often overlooked in financial planning. Getting the balance right between liquid and non-liquid investments is crucial when planning for retirement. And getting the balance right between liquidity, having access to capital in retirement, versus tax efficiency. In order to avoid eroding wealth, we need to make sure we create a framework for decision making where we can make informed decisions. This in turn will ensure that we do not erode wealth by making emotional investment decisions based upon fear and greed. Make sure that every investment decision you make is guided by a solid retirement plan where you've partnered with a financial planning professional. Most people, and this is the reality in our country, never achieve financial freedom or financial independence even. And it's not due to a lack of saving, but it's due to a lack of planning on their part. And if you want to start planning your journey with regards to your financial freedom and partner with someone that can assist you, please get in touch with us at Old Mutual Wealth. We'd love to partner with you. We'd love to get to know you, and we'd love to help you uncover the steps on how for you to achieve financial freedom. Thank you very much for sharing some insights with you on all the elements that can potentially make up a retirement plan.